Every morning, millions of people wake up and immediately rely on infrastructure. You flush a toilet, check your phone signal, drive across a bridge, send money digitally, turn on electricity. None of this feels financial, but increasingly, it is, because over the last 20 years, something profound happened, and most people never noticed. America didn't privatize infrastructure through legislation. It sold it, one transaction at a time. Not to governments, not to tech companies, to private equity, quietly. And today, a massive portion of the systems that keep daily life functioning, power grids, water utilities, fiber networks, pipelines, parking meters, and even emergency services, are owned by investment funds you've never heard of. This isn't a conspiracy. It's capital allocation. And once you understand the incentives behind it, you'll see why infrastructure became the most coveted asset class on Earth. To understand why private equity moved into infrastructure, you have to understand pension math. Pensions promise predictable payments. But stocks don't produce predictable returns. Infrastructure does. Toll roads, water systems, electricity grids, they share three powerful characteristics. Predictable demand, inflation linkage, near monopoly economics. You don't comparison shop sewer providers. You don't choose between competing bridges. You don't negotiate electricity pricing daily. Which makes infrastructure different from almost every other business. It isn't cyclical. It's essential. And in a low interest rate world after 2008, institutional investors desperately needed something stable. So money moved. Not millions, trillions. Global infrastructure funds grew from roughly $100 billion in the early 2000s to well over $1 trillion in committed capital. And private equity realized something important. Owning businesses was volatile. Owning systems people cannot opt out of was permanent. In 2008, during the financial crisis, Chicago needed cash. So the city made a decision. It sold its parking meters. For 75 years. The buyer was a consortium led by Morgan Stanley Infrastructure Partners. Purchase price, $1.15 billion. At the time, city officials called it a fiscal solution. Within a decade, analysts estimated the meters would generate over $11 billion in revenue. The city solved a short-term budget gap. Investors secured nearly a century of cash flow tied directly to urban activity. And something important happened. Infrastructure stopped being seen as public service and started being valued as a financial instrument. After Chicago, similar deals followed across the country: toll roads in Indiana, highways in Texas, and airport terminals nationwide. Municipalities traded future revenue for immediate liquidity. Funds traded liquidity for permanent income. Both sides got what they needed. But only one side got long-term upside. If parking meters were proof of concept, water utilities became the prize. In 2021, Blackstone Infrastructure acquired a majority stake in American Waterworks Regional Systems through municipal privatizations and operating concessions across multiple states. Why? Water demand is perfectly inelastic. Consumption barely changes during recessions. Customers cannot disconnect voluntarily. And municipalities often lack the capital to repair aging systems. The U.S. water network requires over $600 billion in upgrades over the next 20 years. So cities increasingly do the same trade. Immediate funding in exchange for operational control. Private equity provides capital. Investors receive regulated returns, often contractually tied to inflation. Water became not just infrastructure, but a bond replacement. Then came the biggest shift of all. Infrastructure stopped being physical and became digital. Cell towers, fiber networks, data centers. In 2020, Brookfield acquired a controlling stake in data center operator Data4 in Europe. American Tower, originally a real estate spin-off, became a $100+ billion company owning cell towers globally. Private equity firms including KKR and EQT spent tens of billions buying regional fiber networks across the United States. Why? Because digital usage behaves exactly like utilities. You may cancel Netflix. You won't cancel internet access. Bandwidth became electricity. And connectivity became a regulated necessity, just without regulation. Infrastructure investing had evolved. From roads and bridges to the rails of the digital economy. Energy infrastructure completed the transformation. Funds like Global Infrastructure Partners, BlackRock, and KKR acquired stakes in pipelines, LNG terminals, and power transmission systems worldwide. In 2021, BlackRock led a $12.5 billion acquisition of Global Infrastructure Partners itself, a deal Wall Street barely discussed publicly, despite controlling critical energy transport assets across continents. These assets don't depend on commodity prices. They depend on volume. And societies don't stop consuming energy during downturns. Which means infrastructure doesn't just generate revenue. It generates priority revenue. Paid first. Before discretionary spending. Before growth investments. Before expansion. This isn't about funds taking over public life. It's about matching liabilities to assets. Pension funds owe retirees steady payments for decades. Infrastructure produces steady payments for decades. So capital flows towards stability. Private equity didn't set out to own infrastructure. It followed incentives until it ended up owning the foundations of daily life. The deals weren't coordinated. They were inevitable. And once capital enters an asset class built on necessity, it rarely leaves. Most people think finance operates in stock markets. But the most important capital markets aren't visible. They're embedded. In water pressure. In signal strength. In traffic flow. In electricity stability. Private equity didn't buy the economy. It bought the systems the economy depends on. Quietly. Because the best investments are the ones nobody notices.